Good morning, students. So we will be discussing today March 2021 question paper, which we have maybe you all would have got the paper as well as the suggested answer of the institute. You can go through the website also. There are 3 questions, as you know the structure of the paper. There are 3 questions. Question 1 and 2 have 25 marks each, and third question is a case study which has 50 marks. Generally, the case study structure is where you are given a pre-seen material, which as students you have to go through and analyze the case before you attempt the case in the exam hall. So in the exam hall, you will be in your paper, you will get a unseen material, which is basically the same case study. There will be some additional information they will give you for you to attempt the question. So that is how the structure. Question 1 and 2 is only 25 marks question. It will be having sub questions, as you may be knowing, and you would have done many papers, right? We will attempt the question number 1. Okay. So question number 1, you could see it's about a company called ABC Private Limited. It had been incorporated 5 years, few years ago, and then they are doing industrial gloves to the European market, and then they have been successful in their business. And they say the company's key managers are rewarded based on earnings. So basically the key management people are rewarded based on their earnings, based on the company's earning. The board of directors has now realized that they need to change its business model and strategy to suit the changing market trends. In the light of this change, the objective statement of the finance management function needs revision, as it was set long ago by the previous finance director who is no more with the company. The objective of the finance management function, what they say, is the maximization of the value of the ABC, maximization value of the ABC. The chairman was hesitant about the specific meaning of the above statement and raised some queries. So the chairman had gone through this, and then he had been asking few questions. One question: what is meant by the term value maximization in the context of ABC from a shareholder perspective, employees perspective, and customers perspective? So that's about value maximization from 3 people perspective they is asking. Second is talking about whether profit-based remuneration to key managers would help value maximization. That's the second part. Third, the shareholders have specified a minimum rate of return on capital employed as well as maximum level of gearing for each department within ABC. So they have given 2 financial objectives of the company. Could this be a destructive to the firm's value creation process, or rather would it help the value creation process in the long run? So it is destructive or it will help the value creation. So 10 marks question. Explain each of the queries 1 to 3 above raised by the chairman. Explain each of the queries. So it is about explaining the 3 questions asked by the chairman, 1 to 3. So we will take one by one. So the first part, what they ask, what is meant by the value maximization? Now as you all know, primary objective of the companies is what? Maximization of shareholders' wealth. So as we know that this is the primary objective of the company. Any company you take world over, the primary objective of the company is maximizing shareholder wealth. But then you will have other objectives. These are called secondary objectives, right? Secondary objectives, which can be financial and non-financial. Financial and non-financial. I am just initially touching the theoretical framework for that you understand what we are going to talk. Secondary objectives are financial objectives and non-financial. So you will have financial objectives. It can be your GP margin and the profit target and earning per share, gearing. So you would have various financial objectives. You can add on. Then from non-financial objective, you can see the quality of the product, and your working environment, working environment, and your what you call the overall satisfaction of the employees, overall satisfaction of the it can be objective, overall satisfaction of the employees. So you would see there are financial, non-financial objectives as secondary objectives, and primary objective being maximization of shareholder wealth. So this is generally the organization objective framework. You have it in any company. Now the question is about what is value maximization? Value maximization. So in our answering, we need to say that value maximization can be looked at from various stakeholders, right? The stakeholders could be your shareholders, employees, customers, management, creditors, and financial institutions. All are stakeholders. So these stakeholder, each stakeholder has an objective towards the company, So if you talk about value maximization, from the shareholder point of view, your value maximization is about your wealth. You are referring to value maximization of shareholder is the shareholder's perspective value maximization. You would like to see your shareholder wealth to be increased, or you need to create more and more wealth for shareholders. That is value maximization of shareholders. If you take the employees value maximization will happen. As I mentioned, the employees will have their own objectives. You and me as employees will be having an objective towards the organization, where we would say, okay, we need a decent salary and remuneration package, and we need the insurance cover, we might look for the bonus, and we need the recognition. All these we look from the company. So these are our objectives. So when you say that employees' value is maximized, when you say that the company has satisfied the employee by giving what they are expecting. So if the company is going to give you the salaries and the remuneration package and the medical benefit and even other whatever you are expecting, if the company is trying to go beyond whatever you are expecting, then your value is maximized. So whatever you are expecting, if the company is giving, your value is maximized. So please note, it's generally you go beyond, the company go beyond what the employees are expecting, then only the value gets maximized. Okay. Third, customers point of view, all the customers would look forward to get the quality product, accessible everywhere. You would like to, so example, you might be having, you may be staying in one area, village, but you would like to have the products available in your village also. Not that you need to come to the town or the city to buy the goods. You should be able to buy the goods from anywhere. That means your accessibility of the product, quality product, and more important, you need to get your products at the lowest price. So you would like to have this balance, quality, everything with the lowest price. So if the company is going to give you beyond that, your expectation, then your value is maximized. So even if you are getting what you want, your value is maximized. So you don't want to complain about the company. So you are fine about it. So these are the value maximization from different perspective. So that's basically your first part. Second part is about whether the profit-based remuneration to key managers, would help value maximization. Whether profit-based remuneration to key managers would help the value maximization. Now see, if you are talking about shareholders, they have a maximization of wealth for themselves. They have wealth to be maximized. Employees or the management staff, they have their salaries and all the perks. In this case, they are saying the key managers will be given profit-based remuneration. Now that kind of thing, will it maximize the wealth of the company? Truly speaking, the employees will be very much happy, because when they are making profits, they will get their perks more and more. So more and more profits, more and more remuneration to the employees or senior management. But when they have a target for a year, it's not long term, 1 year period, they would like to achieve a lot of profits. Why? They get more paid, more remuneration paid for them, because when the profits are more. So they will try much as possible to take action and do they carry out strategies for short term profit making. Actually, wealth maximization for shareholders is a long term phenomenon. It's not short term thinking. So you don't try to push things to achieve short term profits. You need to always look at the long term value creation for shareholders. That should be a primary objective. But when you are going to give the remuneration to the key management based on the profits, they would try much as possible to earn more profits for a short period. So that is a disadvantage. Why? When they go to make a decision making, they will concentrate on the short term profit making and ignoring the long term value creation. If you are ignoring the long term value creation, it's actually disturbing the shareholders' objective. So that is what we have to understand. In this case, profit based remuneration, even though it looks sometimes good for the organization, but if the management doesn't consider the shareholder objective as a key objective, and they work for their personal objectives to achieve more profits and more remuneration, then it will be a disadvantage to the shareholders. So that is something we need to say. The value maximization will not be helped by the profit based remuneration. Then the third one they are talking about, the shareholders have specified minimum rate of return. Shareholders have specified minimum rate of capital employed, rate of return on capital employed, as well as a maximum level of gearing for each department within ABC. Could this be destructive? The word is, could this be destructive to the firm's value creation process, or rather would it help the value creation process in the long run? Now see, you have a objective. Already you have a long term objective. Assume that you have value creation process in the your long term value creation objective. That is your primary objective, maximization wealth. But you have for the company units, they call it each department. For each department you have return on capital employed and maximum level of gearing. So your gearing level. So you are given targets. You are given targets for return on capital employed and gearing level for each department. Now the question is asking us, when you give this kind of thing, short term financial objectives, will that be destructive to the long term value creation? It's like this. The organizations, as I mentioned at the beginning, organizations' primary objective is to maximize the shareholder wealth. Actually, the organization main primary purpose is to maximize shareholder wealth. But the shareholders are the one who created the companies. So you have to look after them first. True that you, while doing it, you have to look after, there are many stakeholders in the company or to the company. You have to look after all those people. But finally, the primary objective of yours is long run, where wealth has to be increased for a shareholder. That has to be there. Otherwise, no point the shareholder put the money and waiting for the return, because shareholder is somebody who takes the risk, and put the money. All other stakeholders don't have that risk. Right? It can be customers. Customers actually is a short term. He just buy the goods and he finished. The next time he can move into another company. And the supplier is same. He can move into another company. Employees also can leave. But shareholders also can sell. But shareholders, if they started the company and assume that there is no one to buy your shares, you are running the company. So you take all the risk. Entrepreneurship is that. You are taking the risk and there is no guaranteed return for you also. At least employee, you know definitely there is a salary going to be there. Customers will know that, okay, I am getting a product for the price that I am paying. Supplier knows my payment is coming. Banks have understood. So these all stakeholders have their clear-cut objectives being achieved. This too, if you are saying any financial objective you give it in the organization, will that impact your long-term value creation. Organization needs to work, organization should have the financial objectives, you will have financial objectives. Only thing, the financial objectives have to be in line with your long-term value creation objective. That is important. Here the linkage between your financial objective you are giving to the departments and your long-term value creation should be in line. Same, both needs to be in the same line. That is more important, because you cannot achieve these objectives indirectly. You will destruct your long-term value creation objective. You can't do that. You need to make sure that your departments respective the objective whatever you are given as shareholders should be in line with the long-term value creation. As far as your objectives are very clear and it is in line with your long-term objective, you will create value. On the other hand, if you are going to have a target for a department where you should have minimum return of so much and this is your maximum gearing, and then that kind of objective you are focusing more, you may ignore the long-term value creation objective. You might disturb or you might ignore the long-term objective. So that is what I told you. You need to make sure it is in the same line. It doesn't actually mean that you can't have the financial objective for departments. You can't. No, you can have. You should have. Only thing, you have to make sure it is in line with your long-term value creation. Because if you are going to have a conflicting objective between these two, then the objectives on of overall perspective is lost. Okay. The other important thing, when you talk about stakeholders, different stakeholders, I think the overall I am just talking. Overall, if you look at it, there are different stakeholders, customers, employees and various stakeholders are there. Their objectives, when you are going to achieve, you need to balance with the other stakeholder objective. Because you cannot ignore one stakeholder objective against the other stakeholder. You need to balance all the stakeholders, because sometimes when you want to achieve the one stakeholder objective, for example employees, you want to give good salary, good benefit, all that. True that employees will be feeling good and their value get maximized, but shareholders will be penalized. Shareholder return comes down. So you need to balance these objectives. Wherever there is a conflict, you need to balance these objectives. So that's basically this area where they wanted you to explain these overall concepts, the value maximization from different perspectives, and whether the short-term profit targets will disturb the long-term value creation. Definitely yes. Third, the department specific objectives or maybe the returns requirement will affect the destructive to the long-term value creation. It may or may not, because sometimes if you are having only a specific objective of the department, so you need a return, minimum return for the department, you will work for that minimum return thing. When you go to do that, as an organization, long run, you may lose the value. Right? You will do things to achieve the department objective, only department objective, rather than looking at the overall picture. This happens mostly. This is something which happens when you go to the SPU units to say that you need to achieve this. The SPU will targeting to achieve somehow that. They don't mind even about the other SPUs. Other SPUs may not be benefiting out of your decision making, but they are not caring because they think, okay, I am fine. That should not be the case. That even that division, when you are looking at your returns, you need to have underlying objective is the long-term value creation of the company. So as far as you have an understanding and work towards that in your all decision making, then the conflicts will not arise. Okay, that's about your 10 marks question on the question number 1. Right, you could go through the suggested answer, right? Suggested answer of the institute. Also, you can go through, right? So I am only discussing the key points in each area. So you please go through the suggested answer. There are certain things I may be giving extra information or maybe showing it in different ways. So understand that concepts. Then the B part, what they are saying, ABC received many queries from the regular buyers from Europe to supply medical disposable gloves instead of industrial gloves, As a company is capable of supplying medical gloves in large quantity, the company has accepted long-term order. However, ABC needs a larger production facility for this purpose. So, they have got order, they need larger production facility. Current production facility has been taken on lease and it's modified by ABC, the company, or at a cost of 6 million to suit its needs 5 years ago. So, that 6 million was incurred 5 years back and the lease agreement will expire immediately. So, basically that lease is done and finished because it's expiring. Management is considering two options which are given below. So, what are the options? Option 1, they are talking about option 1, extend the current lease agreement by another 5 years and enhance the production flow to meet the requirement. The revised lease installment, now, so they are basically getting a current lease agreement, they are extending for another 5 years, so it's basically a period of 5 years. Enhance the production flow to meet the requirement. The revised installment per annum, lease installment per annum will be agreed at 4.5 million today's terms. Today's term in today prices. And for lease installment, an annual increase of 2% will be applied. Annual inflation or annual increase of 2% will be applied on top of general inflation for the respective years. So, please understand, your lease installment is 4.5 million, today's prices. It will go up or increase by 2% every year in addition to general inflation for the respective year. So, we need to understand there may be inflation, in addition another 2%. So, altogether there is a X amount of price increase you will see in the lease installment. The lease installment will become payable at the end of each year. So, it is starting from the end of the year. Further, contract will be signed with the vendor to extend the production flow with a special structural engineering method which is removable and reusable at a cost of 40 million and total contract value will be paid in 4 equal installments. So, basically we are talking about structural engineering, special structural engineering method which will be used and then reusable. 40 million rupees is the cost and the cost will be paid in 4 equal installments and 10 million each at the end of first 4 years. So, that is 40 million payment. The rates will be ABC responsibility which is estimated 250,000 per annum. So, they are talking about special approval has been granted by tax authority to claim capital allowance over a period of 4 years from its inception. So, basically you are able to claim tax benefit. The extension work will be returned back to the vendor for an agreed market value of 25 million at the end of lease period. So, after lease period, that is 5 years, you can return your whatever the structural work and you can get 25 million. You spend 40 million and you get 25 million. That is option 1. That's about option 1. Option 2, they are talking about larger property buying and then they are modifying they are buying a larger property, not the lease, it's buying. There they say purchase consideration modification cost, they are given 40 million, 10 million and then they will be saying the time period and the rates are given and the realizable value is given as 55 million at the end of year 7. Production facility will be relocated to a larger premises in 7 years from now. So, this is about 7-year period. Now, see the two options. Both options is about the cost incurring. No revenues are given other than the tax saving you will have and your realizable value. But otherwise, it's all cost related aspects. But you are talking about 2 time periods. One is 5 years and 7 years. So, there are 2 time period, lease installment or any other payments or the rates and stuff and the tax benefit given and the residual value given, 2 options. And they say the inflation is 5% per annum for the next 5 years and 7% per annum thereafter. So, first 5 years 5%, 7 years, 6th and 7th year 7%. Actually, the second option has 7-year period of evaluation. So, you have to consider inflation for 2 years. Nominal weighted average cost of capital 15%. So, WAC is 15% and tax is 28%. Both options will come to play immediately and you may assume that no other expenses will be impacted other than expenses mentioned above. So, basically these are the expenses we are talking about. Evaluate option 1 and 2 above on financial grounds and give your opinion. clearly mention your selection methodology and any assumptions made. So it's basically about 15 marks question. 15 marks question. They don't know or they don't say what basis of your evaluation going to be. They only say that you have to evaluate based on financial grounds and give your opinion. So you can mention your assumptions and your methodology. So first look at the question. What kind of question it is? It's about production facility. One is on a lease basis. We are going to get the facility. Other one is on the what you called you buy the property and you modify. So use it for some period of time. So no revenue side of the story. It's only the expenses side of the story, because what I am trying to say is it's not a normal NPV calculation where normal cash flow or project evaluation viability of the project. Here is about two options of using your production facility. So or getting your production facility. So we are asked to calculate or evaluate based on a financial ground, see what option is better. So we have to decide which option is better. So the evaluation methodology has to be decided. As you know, these are long-term cash flow question. So definitely we have to use the NPV concept. NPV concept. So we can use the NPV concept and compare the two options. Only thing, when you look at this option, two options, one is 5 years, other one is 7 years. So since you have two time period, since the time periods are two different time period, you cannot just compare the NPV of two projects. It's not about revenue related project, right? Here it's about the only the cost related aspects are given other than the tax benefit. So we need to evaluate, more meaningful evaluation will be your time period considered evaluation, which is called equivalent annual cost method. So equivalent annual under replacement decision you would have studied under theory, right? Equivalent annual cost method we have to use to evaluate this option. First we calculate NPV of two projects or two option. Then we calculate equivalent annual cost, that is basically you convert your NPV into equivalent annual cost you have to incur for respective years. So you are, otherwise you can't compare the 5-year and 7-year cash outflows or the NPVs. So option 1. So option 1, shall we try the option 1? Option 1, you are going to extend the lease. Extend the lease. Option 1 is extending the lease. So you could read out that. So it's about 5-year evaluation, as I mentioned. Here 0, 1, 2, 3, 4, 5. 5 years evaluation, and you can put in rupees thousands. Rupees 1000. So your lease installment so you are talking about 4.5 million in today's prices, 4.5 million in today's prices, and they say 5% inflation is given, 5% inflation is given. In addition, there will be 2% increase in your value or the installment value. So totally 7% increase. So you will see that 4,500, that is your today's prices, and then the installment will be increasing based on inflation and another 2%. So there is a 7% inflation or 7% increase you will have to have for your lease value or lease installment. So year 0 you don't pay anything, because they say that your installments are paid only at the end of the years. So installment of 4.5 million, the installment will become payable at the end of each year. So basically we are talking about revised installment will be paid over the future period, that is 5-year period. You have to find out how much the amount is. So you can calculate the number 4815, that is 4,500 into 1.07, 4815. Again another 7% increase, 5152. 5513, 5899, 6311. So this is every year your lease installment will increase by 7%, 7% increase. Then the rates. So rates, what they are saying 250,000, 250,000 is your rates. So 250,000, again that also will have a impact. In this case, the inflation impact only will come. For rates, you don't have the 2% additional impact. It's only the 5% inflation, 5% inflation. 5% general inflation will be there for rates. So 250,000, that is at today's prices. So year 1, you have to pay 263. Since it's mostly the cost items, I am not putting brackets, right? So please understand, right? All the cost items. 263, then it goes up by another 5%, 276, 289, 304, 319. So this is your rates. Then we are talking about the structural work. For that structural work, you have to pay 40 million, you have to pay 40 million, but you are going to pay over the 4-year period, 10,000 each. 10,000 each you will pay for structural engineering work. And they say that after the lease period is over, you can return your structural work to the same vendor and you should be able to get how much? You will be able to get 25 million. So that we can take it and the same, it's the receipt actually. Structural work, I am mentioning the payments 4 years and the recovery at the end of 5th year, end of the 5th year. So this will basically, you have your cash flows. So you will say that this is your net cash flows. So you can calculate your net cash flows. 15,000, 428, 15,802. So we need to know that there is a tax benefit at 28%. Tax benefit, you will have tax benefit. So it's a benefit of tax 28% on the total amount. So they have mentioned you may assume that a special approval I think you can read it out. You may assume that in the question 1, you may assume that a special approval has been granted by the tax authority to claim capital allowance over a period of 4 years from its inception. So actually here the lease installments and the structural work, we believe that we are able to claim benefit. So the capital allowance, of course, we have taken 4 years for the structural work, but lease installment we are claiming for the 5 year. So if you would like to take that, the assumption is like lease installments are claimable over the 5-year period, so which can be claimed. But structural work, they are clearly said it's 4-year claiming, so your capital allowance will be claimed over the 4-year period. So the tax benefit you will have, all the other rates, expenses also you have a tax benefit. Generally the expenses have a tax benefit to you. Income will be, you will pay taxes, expenses you get a tax benefit. So 4222, 4320, 4425, 4537, 5143. That's actually you may look at your suggested answer, because I am not going to take all the numbers and rewrite the whole thing. You can look at suggested answer, right? So then you have to take your net cash flows net cash flow after tax. After tax, you can take the cash flows as per the suggested answer. Then you discount your WACC. WACC is your discounting factor. At 15%, you discount your cash flows. And you get an NPV. You get NPV 25,414. 25,414. So you will see that 25,414,000 is the NPV of your option 1. Right? So you could look at multiplication of your WACC at 15%. You can discount your cash flows. You get your 25 million NPV. Now this is actually a minus NPV because these are all our expenses. So you have 25 million negative NPV. But both options are negative NPV. So you don't have to think whether it's positive or negative. Both are negative. So you see the lowest NPV and decide which is better. So 25,414 is the option 1 NPV we are evaluated. It's a 5-year evaluation. Okay. Then moving to the option 2. Option 2 is about you buying. Option 2 is about you buying the property and modify. Buying the property and modifying. Buying the property and modify. So this is again rupees 1,000. As I mentioned, this is actually 7-year evaluation. It's not 5-year evaluation, it's about 7-year evaluation. So if you have, as we went through the question earlier, it's about 40 million you have to pay for the property and modification cost will be 10 million respectively. The purchase consideration will be paid. Purchase consideration will be payable or paid at the beginning of the year 1. Purchase consideration will be paid at the beginning of the year 1. So please understand, purchase consideration will be paid beginning of year 1. Year 1 beginning means year 0. So you are talking about, again as I mentioned, we don't want to put the minus because all are expense cash flow. So 40,000 or 40 million is your year 0 purchase consideration. Then your modification cost, what they are saying, the modification cost will become payable at the end of year 1. So you can take the modification cash flows, right? Modification cash flows, 10,000. Only thing I would rather say, as the suggested answer says, it's your tax benefit is there for your expense. So you get the tax benefit from your 10 million, 28% tax benefit you can get it. So when you minus it, your net expense is 7,200. So 7,200 is the year 1 your cash outflow. 7,200 is the net cash flow. Then your rates what they are given, 300,000 in today's terms. Your rates is 300,000 in today's terms. So you could say that in the suggested answer, I'll show you. So you can see there is a working given for rates, right? The cash flows are given with the inflationary effect for 7-year period, because 250 or 300,000 is the rates today's term. But as you know, there is a 5% inflation every year. So on that basis, you are basically given the 7-year rates amount. And the tax benefit is also given. Tax benefit is also given as 28%. So net of tax, you will see the rates. 227, 238. You can see it in the suggested answer also, right? For your understanding, I am writing 250, 263, 276, 295, 316. Okay, so these are your rates net of tax. Rates net of tax. So we straight away take the impact of tax also. Then your capital allowance benefit. Capital allowance benefit for your what you call modification cost, not modification, the purchase consideration. But they are saying the purchase consideration will be having the capital allowance benefit. ABC will be allowed to claim capital allowance at the rate of 10% per annum on purchase consideration. So your 40 million investment purchase consideration is entitled for 10% capital allowance per annum, that is 4,000. So 4,000 is your per annum capital allowance, on that 28%. That's your tax benefit. So your capital allowance is 4,000, on that 28%, that is 1,120. So you will see 1,120 for 7 years. 7 years you will have tax benefit. These are expenses, so benefit we take a minus. Since expenses we have put it as a positive number, your benefit you will put it as a minus number. Okay. Then your residual value, it's 55 million residual value, and tax on residual, since you are getting a residual value at the end of your period of your project, you are getting a residual of 55 million, on which you have to pay tax at the rate of 28%, which will be 15,400. So 15,400, 55,000 is your residual, it's a positive figure. Actually we mentioned negative because all our expenses are positive we have mentioned, and tax your payable, that's expense, that will be plus figure. So you can take all your net cash flows, you might see the suggested answer straight away, right? So if there are and difficulties only we have to look at it, otherwise these are very straightforward thinking. Somebody might think that your what you call the property what you have bought, you are able to claim capital allowance, for 7 years. After that you basically shift your property, or basically you shift your location. So after 7 years you can't claim. So when you say your disposal value, residual value, we have taken 55 million as a residual value. On the 55 million, normal situation what we look at is we take the tax written down value and minus and calculate your tax amount. But here I have taken 55 million on which straight away the tax, right, on the assumption that your tax written down value, because that after that point you are anyway you can't claim capital allowance. So only 7 year useful life, so that is basically gone. After that you can't claim capital allowance. So therefore your disposal value, entire disposal value will be liable for your tax, So on that assumption we have taken, right. So in otherwise you would have taken your net book value and compare with your 55 million disposal value and calculate your tax on the disposal. But here we have taken your entire value of your what you call disposal value will liable for tax. So if you can make a note somewhere. Entire disposal value is considered to be tax liable, because only 7 years you have claimed capital allowance, you have not claimed 100%. So you have still a tax written on value. So your entire disposal value you cannot be paying taxes, you have to minus your tax written on value. But we assume here entire disposal value is liable for tax, right? So on that basis we have calculated the tax amount, and on that basis you get your net cash flows. So you get your net cash flows and your discounting factor at 15%. Same cost of capital, we are comparing two options using the same cost of capital. Otherwise it's meaningless. You cannot compare, evaluate in one option under one cost of capital, other option other cost of capital. You have to use the same cost of capital. So then 15% is your cost of capital. On that basis, your NPV 27,789. This expense cash flows based evaluation. So your 27,789 is actually a minus, but we don't want to worry about it because both options will have a minus NPV. So it's 27,789. So that's basically, you can see it in the suggested answer as I showed you, 27,789. Now we compare the options, two options. So option 1, option 2, we take the NPV. So NPV in thousands, option 1, 25,414. These are expenses, but we say NPV, we compare because both options give you positive and negative NPV. Since it's a negative, we are not putting negative or positive, we are just saying the number 28,743. So based on NPV evaluation, you would see the lowest cost is option 1. So when you compare two options, one is 5 years, one is 7 years, but based on NPV evaluation, you will see option 1 is the better option because it gives the lowest NPV compared to two options. But please note the time period of these two options are different. It's not the same. One is 5 years, other one is 7 years. So ideally this kind of evaluation, these are based on cost basis of evaluation, or mainly your cost is the item or the cash flows of the project. We need to calculate equivalent annual cost. So what you need to do, you have to divide equivalent annual cost, your cash flow divided by your annuity factor. So please note that you need to calculate your cash flow divided by annuity factor, or not cash flow, the NPV divided by annuity factor. You calculate, I think option 1, the annuity factor is 3.352. So the annuity factor, when you divide your NPV, you get 7581. So option 1, 7581. Option 2, your NPV is 27,789 divided by, again, equal annual cost divided by 4.16 your annuity factor. That gives you equal annual cost 6679. So please note, simply based on NPV comparison, option 1 and 2, option 1 is better based on NPV calculation. But truly speaking, these are two different time periods, so we are converting this total cost in terms of present value into equivalent annual cost. That means annually you are supposed to incur this cash outflow. So this is your cash outflow you have to incur annually. On that basis, 7,500 and 6,679. Okay. So on that point, we say which option is better? Based on equal annual cost, which is more appropriate for this project or this evaluation, because there are two time periods and especially cost based evaluation, cost or expenses based. So we will say option 2 is the better option. So that's basically the question. Evaluate option 1 and 2 on financial grounds and give your opinion. So opinion is option 2 is the better option in terms of equivalent annual cost basis. Clearly mention your selection methodology and any assumptions made. So as I mentioned, only assumption I have made apart from whatever they are given is basically you are able to not able to claim capital allowance or the tax benefit for your rates and the lease installment, that is one. Second, your residual value of the option 2, you will be charging tax on the entire disposal value, Okay, so that's your question number 1. So it's actually reasonably NPV based or the present value based calculation. This is your based on present value calculations, and how to apply inflation rates into your cash flows. Then it's about the tax impact or tax saving on your expenses. Generally we might think these are just the last item or tax, but in this case the tax is an important role, where you have a tax benefit on your expenses, capital allowances, and you are liable for residual. So all that tax impact has to be looked at. Then your WACC, both they have given you WACC for both options, so you evaluate the WACC or use the WACC to calculate the NPV. But finally there are 2 time periods, so we have to show the difference. Question number 2. So question number 2, if you read, Sri Lankan real estate has been growing at a healthy pace with many sky rises appearing in Colombo. At a banking forum, a veteran banker warned that there could be a property bubble in the future real estate market. This may be further aggravated by the impact of COVID-19 on the retail and commercial sector. Required question, A part of the question, explain the meaning of property bubble. And list 4 key risks. That need to be considered in evaluating real estate projects for lending purposes by bankers in a post-COVID environment. So the 5 marks question. So what they are trying to say, in Sri Lanka, and all of you all know that, especially you take Colombo, you will see there are many high-rise buildings, right? It can be commercial properties or it can be apartments. So there are a lot of properties in the Colombo, mainly Colombo central area. You would have seen it, lot of properties coming up. So what they have said, one of the veteran bankers warned, there can be a property bubble in the future real estate market. So what is the property bubble? Property bubble is where due to the continuous demand, there will be more and more property high rises coming up. So due to the demand, the prices or the property comes up. So when the property comes up, right, because there will be more and more properties are built. There will be more engineers building or the more construction developers build apartments and commercial property. When there is a properties coming up, the demand continue to increase, the price of this property goes up. So price of this property continue to increase. So you will see that sometimes I am sure personally I know that you also know that some of the properties are very exorbitant prices, right, huge amounts. So property prices are going up very much. These are especially the high-rise buildings. We are not talking about land only, right? We are talking about property, apartments and the complexes. Its prices are going up severely. Now when it goes, there will be a point at which you will realize there will be excess supply of properties in the market. Right? Now suddenly somebody says, okay, there is a demand. Then every company, every group will start looking at the property construction. So when they go to start construction and they put up apartments and shopping complexes. So everyone start doing it, what happens? Whenever you get more and more properties coming up, there will be more supply. What happens to the price? The property bubble is that you have created a demand continuously and the prices of the properties have gone up significantly. So that is a property bubble. The increase of the prices of the property due to the continuous demand for the apartments and other complexes. So the property prices have gone up. The disadvantage or the problem will be at a point due to the excess supply of the properties, the prices start falling. That is called property bubble burst. Bubble get burst. So the bubble will get burst after a point where you see the supply is very high and the price of the property are very high. So nobody can buy that, or like it's like too much. People, general public cannot think of it. So then the property prices start coming down. So this is called property bubble, and it get burst. So that's your first part of the question. Second part, they ask, list 4 risks that needs to be considered in evaluating real estate projects for lending purposes by the bankers in a post-COVID environment. So it's about bank point of view. Bank's point of view, what are the risks? Banks should look at it before lending money to real estate companies or real estate projects. What are risks that need to be considered by the bank before lending money to real estate company? Actually, this is 2021 March paper. That was the latest paper. 2020 December, which is an online paper, online exam, that paper also tested this area, where they gave an example of this property and lending by the banking institution. So those who have done that or would have seen that paper and the answer, you would have got some idea that this is similar or reasonably the similar idea or thinking. So bank's point of view, what are risks they have to look at it? If you are going to lend money to a property developer, post-COVID environment, they are talking about when you are going to lend money to real estate projects, what are the factors to be considered, or what are risks you need to consider. Please understand, one is the property developer. Financial strength. You need to look at whether the property developer is strong enough, because these are very uncertain situations, right? Even though COVID-19 environment, we are talking post-COVID-19 environment, still that this risk is not 100% over, and due to the COVID, there are a lot of people went through difficult times, so the income levels have come down. So the demand, genuine demand for this kind of apartments and complexes, people to buy or even to rent it out, it's going to be a difficult task. So the demand may not be there. So at this time, if the project what you are trying to do, if it get fail, you need to make sure that you are able to recover your lending money. Actually, you are talking from bank point of view. So bank should be able to recover the money what they are going to lend to the people who are doing the real estate projects. So property developer financial strength or financial status, are they strong enough? Are they able to continue this project even if the project doesn't materialize or realize the apartment sale or the complex sale within the shorter period, whether the developer has the capacity to continue the business for some time. Otherwise, if he is a small player, he will suddenly stop the project and say that project is over, or he can't, or he will declare and you may not be able to complete the project. So that is something you need to be looked at. That's the main risk you have to look at, whether they are able to repay your outstanding. Then the demand or the market risk, we call it, right? Demand or market risk. Do you have sufficient demand for this products or outputs of these real estate projects? Whether these apartments will have a customer, right? Actually, everyone knows that there are a lot of complexes which has come up, right? Due to this COVID also, there are a lot of places people have given back their properties which were taken on rent. So they are not able to pay the rent even. I am not talking about buying. Even the rented premises, they are not able to pay the rent because there is no business. Their businesses are lost, so their incomes are not generated, so they are not able to pay the rent even properly. So in that case, if you are talking about a construction companies who are developers who have put up apartments and complexes, they may not be able to find the buyers. Even if the buyer initial installment, if he pays, later installment he won't be able to pay because he is in trouble, his business is not doing well and his incomes are not sufficient, so he will default. So that is the disadvantage. So demand, you need to see whether there will be a sufficient demand in the market for this kind of apartments or complexes over the next few years. If you don't see that, you should be avoiding these kind of loans to be given to the people, because it's a very uncertain situation, may not be able to recover your capital and the recovery of the installment as interest. Then third one, your macro picture, right, your political stability, because some of the policies, some of the encouragement given by certain governments will be helpful for the real estate property developers, but on a long run it may not be, So you need to see that political stability, how long it will be there, whether there will be impact. Then the interest rate risk, and if you are going to borrow money from foreign for the project, whether the project will have impact of this risk, interest rate risk, exchange rate risk, you have to look at it, how that will impact this project before you giving the loans to them. Interest rate risk and the exchange rate risk. Then your gearing, how it affects, because if you are saying the project is funded by shareholders, say 40-50%, and the bank is 50%, then you have a risk managing or risk sharing. But if you say the bank is giving 80% of the money needed for the property project and 20% only shareholders are putting, then the risk is very high. So the gearing aspect has to be looked at as a risk, because if the gearing is very high, then the bank is in trouble. So that is another risk to be considered by the bank before giving money. Then the cash flow risk. What I mean is, like, whether the company would be able to get the cash flows on a macro picture on a regular basis. If the cash flows are not going to come on a regular basis, then you are not able to recover your money. Maybe the property is worth, the value of the property is good, but sometimes the property, even though valuable, as a project, because bank is not interested about the property, bank is interested about interest. The bank's business is what? Give money as a lending or loan and get income. So bank's main purpose is to earn interest income. It's not about you just buying a property. It's not in the property business. Bank is lending money. It's not a property buying, it's a lending money. So lending money, what is your purpose? To get interest income. So your cash flows is the key. So bank's point of view, any project you want to look at your cash flows. So you need to evaluate and see whether cash flows will be there or sufficient cash flows will be there to repay your loan. So this risk has to be looked at before granting any money to the lending to a real estate project. So there are a lot of things, right? Then maybe the regulation changes. It includes the government moratorium levels. Government has given certain moratorium things for the banking institution to give it to the customers who are in difficult situation. So you need to see whether the banks will be getting into this kind of situation continuously, because from bank's point of view, no bank would like to have all the bad customers. No bank will like. So if you take a real estate projects, all because of property bubble or whatever reason, or COVID-19, have got stuck, all the properties. So when the property got stuck, property developers will not pay, and the bank, if the one bank has given more loans to the property sector or real estate sector, you are in trouble. So you need to be sure that, make sure your risk is minimized before granting loans to this sector. So macro picture has to be looked at, right? Regulatory changes, what I meant by regulatory changes is moratorium, even the tax regime benefits, any tax related or macro related, government rules comes in, right? The port city is one project which is coming up. There are enough new regulations. So you need to know that whether I am giving money to anybody in this related. So am I going to get benefit or losing money? So will we be getting into problem? So please note, these are all risks you need to consider before giving to real estate company post-COVID situation. Then the B part, question number 2. Question number 2, the B part. During the lockdown period, Central Bank of Sri Lanka, in order to preserve foreign exchange, imposed an import restriction where cement imports could be settled on letter of credit basis 180 days. PQR Private Limited, an importer of cement, wishes to place an order with an Indian supplier now for the value of $5 million, where generally it is for 60 days period. However, due to the 180 days period, supplier is requesting an additional 3.5% premium. The finance director feels that Sri Lanka rupee will depreciate by 5% in 12 months time. Current spot rate 185 rupees per dollar. Assume the rupee interest rates are around 12%. Per annum. So that's basically the question. So read the question part. Assess the financial impact. To the company due to this import restriction. Assume that LC is on nil margin. So what is this story about? It's about a company who is importing cement, and as we know, during 2020 March onwards, the government went on lockdown period for 2 months. So during that period, government realizes there will be a problem with the export proceeds. Since there will be impact on the exports or the remittance, foreign currency remittances from abroad, or even the FDIs may not come as we think. So due to that, the dollar coming to Sri Lanka can get affected severely. So at that time, in order to preserve the reserves of dollars, government needs to control the imports, because you need to make sure that exports or foreign direct investment or foreign currency remittances are coming properly. But even though you do all that, it may or may not be, because it's not under your control. So export proceeds of FDI or remittances are not under your control always. So you are knowing that fact, wants to control the imports, so that you are basically making sure that I am not out of stock of my dollars. So government introduced various restrictions in imports. One of the restrictions only this question talks about, but everybody knows that vehicles import is banned. Vehicle imports is banned still today, right? Vehicle imports is banned. In addition, they said there are certain non-essential items, imports are restricted. Non-essential items are restricted. And on the other hand, the export proceeds, they brought up certain rules where the export proceeds can come earlier to the country, so that nobody will be keeping the dollars outside of Sri Lanka unnecessarily. So the government wants dollars, simple as that. So on that line, this example is saying the cement importer, he generally pays in 2 months. The LC open and import cement, pay in 2 months time. But due to the government restriction that your LC has to be 6 months at least, then in 6 months you open the LC. And it's a nil margin, that means you don't deposit any money anywhere, bank, right? Your 6 months LC. So you otherwise should have paid in 2 months. Now you will pay your supplier in 6 months. Since your supplier realizes that you will pay 6 months time, not in 2 months, he is charging you another 3.5% premium on your purchase price or the cost of your cement. So there is a 3.5% charge for the next 4 months, delay in your payment. So that is information given. So other information is given for you to say 185 rupees is today's exchange rate spot rate, and the depreciation of rupee will take place 5% for the entire 1 year. And the examiner is asking us, assess the financial impact to the PQR due to this import restriction. Now before going into the numbers and other things, just see what this is all about. It's about exchange rate risk related question, and we would have learned one of the technique is leads and legs technique. They are not asking about that technique, what it is and all that, but that is the line of thinking here. We will have to pay the supplier in 6 months time. So normally 60 days time you have to pay, now you have to pay 180 days time. So what is your cement cost? In US dollar terms, cement cost is $5 million. If you are buying and paying in 60 days, this is normally if you are going to do. But 180 days, presently because of import restriction of the country, we will be paying the supplier 3.5% more, 3.5% more, that is 5,175,000. 3.5% more than the normal purchase price, so you pay $5,175,000. And this is you are not paying today, the dollar amount you are not going to pay today. So the exchange rate, today's spot rate is not relevant. You can't take the spot rate and multiply this. Maybe for accounting purposes you will be accounting at 185 into $5,000, $5 million for your purchases. That is your accounting. But actually when you are going to pay, you are not going to pay at 185. You are going to pay at the spot rate on the day of payment. So 60 days time, your rupee depreciation will be, your depreciation is 5%, they have given you 5% for 12 months. 5% is the depreciation of rupee, that means your Sri Lankan rupee will depreciate against dollars. Now spot rate 185 per dollar. 1 year's time you have to pay how much? 5% more than this. So 185 is your rate, spot rate. 1 year's time if you are paying rupees against dollar, you have to pay 185 adjusted or increased by 5%. So this is 12 months time. But here we are talking about 2 months time. 2 months time. So 5% for 1 year. So 2 months, your depreciation will be, as a percentage point of view, 0.083. Same thing if you are applying rupee depreciation for 6 months. 5% for 1 year, 5% for 1 year. So 6 months, how much? Half of it. Half is how much? 0.025. 0.025. This is the percentage of depreciation, rupee depreciation, percentage of depreciation, 0.0083, 0.025. That is 2.5% or 0.83%. Okay, this is about the depreciation of exchange rate. Due to that, your US dollar rupee exchange rate, US dollar rupee exchange rate will be, you have to calculate 185, you will have to depreciate by this percentage, that comes to 186.54. Here it is 189.63. Okay, so you can calculate the numbers. So your dollar 185 today's spot rate will depreciate by this percentage and get into a number of 186 point something. That means you have to pay more rupees to buy dollars. 6 months time you have to pay 189 to buy dollars. So the cost of imports in rupee terms, cost of import in rupee term, 932,708,333. Here it's 981,309,375. So these are the cost of imports. So within 60 days if you are paying your supplier, you pay 932 million. Within 180 days if you are paying 991 million. This is because 2 reasons. One, you are paying additional 3.5% and you are going to pay at a depreciated rupee value, so 981 million. Otherwise you would have thought why this is increasing. 2 reasons. One is your premium, you have to pay 3.5 extra, and your exchange rate is depreciating further because you are paying in 6 months time. So these are 2 comparisons. But there is one additional thing. What is that? Interest cost saving. What is the saving? because I am going to pay in 6 months time, I am not paying in 2 months time. Since I am going to pay in 6 months time, I am not going to pay. I am going to compare two options. I am not going to pay in 2 months time. So my interest cost saving is there for 4 months, because otherwise I should have paid in 2 months. Now I am going to pay in 60 days or 6 months time. So 932 million I have saving for 4 months. 4 divided by 12 into the interest cost saving percentage, 12%. So the interest cost saving I am going to have, because I am delaying my payment, I am having a saving which is 12% for 4 months. 4 months. On that is my cost saving or the interest cost saving will be 37,308,333. So my effective cost, this is a saving, effective cost 944,001,042. So please note, this is very important. Since I am going to delay my supplier payment, I am going to save interest on my due payment. Not this payment, this is my due payment. Otherwise this should have been paid. Since I didn't pay 932 million on 2 months time or 60 days time, I am going to save interest at the rate of 12% for 4 months. What is 4 months? 6 months only I am going to pay, 2 months I should have paid. So 4 months I am delaying. The 4 months this money I could be earning interest, so that is 37 million. So that is a saving, this is the cost. So the import cost, net import cost will be 944 million, but if I had paid on 60 days time, my LC was open and I was paying in the supplier in 2 months 932 million. So what is the gap? What is the gap? It is 11.2 million. 11.2 million additional cost. 11.2 million additional cost. Since I am delaying my supplier payment because of government restriction, I have to incur additional cost of 11.2 million. Why this excess cost came? Just if you really look at it, 2 reasons. One, the supplier is charging extra. Otherwise you would have paid $5 million to buy the imports, but now I have to pay $5,175,000. So as a supplier I have to pay extra because he increased the price, because he is getting the payment later. One. Second, since I am delaying the payment, my exchange rate has depreciated further. So that I am losing. Otherwise I would have paid at 186, now I would have paid 189. So 3 rupee depreciation has taken place. So I am losing there also. So one is the supplier is charging additional premium. Second, I have to pay additional exchange rate impact or depreciation of rupee, my import cost is going up. These are the 2 negative sides of it. Positive side, since I didn't pay in 2 months time, my money is with me. That money I have opportunity cost saving 37 million. So in effect, my cost will be, import cost will be, because of the 6 months, 944 million. So when I compare with my normal due payment, 11 million additional cost. The question is asking what is the financial impact? Additional cost of 11 million. Because of this delay, because of this import restriction, the PQR Limited has to pay additional 11.2 million. This is the B part of the question. Can you read the C part? So this is basically the exchange rate risk management question, where how the risk can be minimized. They have not gone into risk management here. They have only wanted you to understand the impact of the exchange rate as well as the import restriction because of COVID-19. So we have to incur additional cost. And the evaluation is that your timing is changing. Because of that, what is the impact you will have? So there is a negative impact because of premium pricing they are charging by the supplier and the exchange rate depreciation. Moving to C part. Can you read C part? Srilal Dias is a charismatic corporate leader. He works as a managing director of food exporting company, Healthy Eats. Srilal is popular among his staff and treats them well. Srilal visits Europe to meet one of his customer and they agrees to invest 3 billion in a new joint venture for 75% shareholding. So please understand, there is a company called Pringley and Sons. Pringley and Sons, he is willing to invest 3 billion. He is willing to invest 3 billion. Right, 3 billion he is willing to invest, and he wants the ownership. He is going to get 75% ownership. So what they are saying, 3 billion new joint venture investor will be investing 3 billion for 75% shareholding. Srilal gets 25% promoter free shares for his expertise. So Srilal will be getting 25% promoter free. That means there is no money he will invest, he will get 25% shareholding for his expertise of this business. So number of shares, so the investment value, it's the value of investment, 3 billion. He will not invest money, but he will get shares 25%. And they say that bank will be giving 2 billion loan at a rate of 8%. Bank will be giving 2 billion at the rate of 8%. And the shares were issued to Pringley and Sons and Srilal at 10 rupee per share. So if it is 3 billion is the investment, he will get 300 million shares. 300 million shares Pringley and Sons will get for 75% ownership. The Srilal owning 25%, he will get how much? 3 billion, 300 million shares for 75% ownership. One third of this is 100 million shares. So total number of shares of this company 400 million. Total number of shares 400 million. But value of the investment is only 3 billion. But number of shares 400 million. 75% owned by Pringley, 25% owned by Srilal. So this is the number of shares of the company. Then they are talking about the new company during the first year recorded revenue of 1.5 billion, and they are given you the ratio earning before interest, tax, depreciation, amortization margin 25% and 5% profit margin, net profit margin. So 1.5 billion revenue and 5% net profit margin. Dividend policy, 50% payout, dividend policy. The company will grow at 10%. So you need to know that your dividend policy is given and your growth rate is 10%. Beta factor 1.2. Assume that treasury bill rate 8%, market return 13. So when we know beta and when we know the treasury bill rate and market return, what we can calculate expected return of the investor or cost of equity of the company using Capm model. We can calculate that. Then the question, Roman number 1. Demonstrate the shareholding structure of the company, the new company, and its gearing ratio, debt to EBITDA, earning per share, dividend per share, 6 marks. So this is simply you are asked to calculate certain ratios and the shareholding structure for the new company. Shareholding structure. So shareholding structure is, what is this? What you have written here. This is not capital structure, right? If the question has asked you the capital structure, you will know capital structure mean it's a equity debt structure. So you would have said 3 billion equity, 2 billion debt, total capital 5 billion. This is a capital structure, equity and debt. And where you can say equity is 60%, 40% debt, total 100%. This is your capital structure. The question didn't ask about capital structure. Question is asking about shareholding structure. Shareholding structure is what? Who are the shareholders? What number of shares they own? What is the percentage of their ownership? So shareholding structure basically tells who are the shareholders, what percentage they own, what number of shares they have. So this is shareholding structure. So there are only two shareholders, 75 and 25, 400 million shares are there. So that is one portion of the 6 marks question. Second, they ask you what is the gearing ratio. Gearing ratio is how much? Gearing ratio is 40%. Gearing ratio is 40%. So you know that your debt is 2 billion, debt is 2 billion, equity is 3 billion. So the gearing ratio is how much? 2 divided by 5, which is 40%. 2 divided by 5. So debt divided by debt plus equity is the gearing ratio. Debt divided by debt plus equity is gearing ratio, which is 40%. Why? 2 billion debt, equity 3 billion. So total capital 5 billion. Out of 5 billion, 2 billion debt capital. So 40% gearing ratio. Then debt to EBITDA. Debt to EBITDA. So they have given you the revenue is 1.5 billion. $1.5 billion revenue. Okay, if you read back, revenue is 1.5 billion and the EBITDA margin is 25%. So 25% of revenue is EBITDA. 25% is how much? 1.5 billion. So 375 million. 375 million EBITDA. This is your EBITDA. And they say 5% net profit margin. So your net profit will be how much? Net profit is 5% of this. 10% is 150 million. Right, it's 1.5 billion, 10% is 150 million, so net profit is 75 million. 75 million is the net profit. And they are saying a dividend payout 50%. Dividend payout 50%. 50% of 75 million, 37,500. This is the total dividend the company will be paying, 50% of dividends or profits, 37,500. So the question is asking you the other ratio you have to calculate. Debt to EBITDA. Debt to EBITDA. So debt is how much? 2 billion. EBITDA how much? 375 million. 375 million. So debt to EBITDA, debt divided by EBITDA equals to 2 billion, right? 2 billion divided by 375 million. 2 billion divided by 375 million, that is 5.3 times. 5.3 times. So that is one of the other ratio you have to calculate. Then the earning per share. Earning per share. So what is the profit or the earning? 75 million. We have to calculate the earning per share. So you know how to calculate earning per share. How to calculate earning per share? Profit after tax divided by number of shares. Number of shares. Profit after tax 75 million. Number of shares, we calculated earlier number of shares. 400 million shares. 400 million shares. So 75 million divided by 400 million. 75 million divided by 400 million. $75 million divided by 400 million, how much? That is 0.1875. 0.1875 per share. Per share. So it's about 18.75 cents. 18.75 cents because you have 400 million shares. 400 million shares. So per share, the dividend per share 18.75 cents. Cents, not rupees, cents. That's your earning per share. Then the next one, dividend per share. So dividend per share, how much? So dividend we calculated 37.5 million divided by again 400 million shares. 37.5 million divided by 400 million shares, which is 0.09 per share. 0.09 per share. So this is your dividend per share. Earning per share, we got it. Now it's a dividend per share. Total dividend, which is 50% of profits divided by number of shares 400 million. Then your dividend per share is there. So that is your Roman number 1. Demonstrate the shareholding structure and gearing ratio, debt to EBITDA, earning per share, dividend per share. So all the ratios we have calculated. These are just to understand that you are able to calculate various ratios. Then Roman number 2. Roman number 2. Compute the dividend income earned by Sri Lal during the first 5 years of operation, assuming there is a withholding tax on dividends of 8%, and assess the value of equity of Sri Lal ownership in Sri Lanka or Sri Lanka LT Produce. So there are 2 parts. One is compute the total dividend income earned by Sri Lal during first 5 years. 5 years, what is the total dividend he will receive? Second, assume there is a withholding tax of 8%. Calculate the value of equity of Sri Lal ownership. So one is the valuation area, valuation chapter. Other one is just calculating the total dividend income. Total dividend income. So as we know that, we were told that your dividend income or dividend, total dividend company paid 37,500 or 37.5 million. Total dividend company paid 37.5 million. So we know that Sri Lal is owning how much percentage? 25%. So 37.5 million is the dividend you are going to pay on the first year. Then you get 25%. 25%. The other owner, Pringley, will get 75% of the dividend for the first year. They are asking about what is the total dividend Sri Lal will get for 5 years. Sri Lal will get for 5 years. And each year the dividend will be growing. Dividend growth 10%. So each year dividend will grow at 5%, 10%. So what is your total dividend? Total dividend 5 years. So you can take 37,500, 25% for first year. Again second, third, fourth, fifth years you have a 10% growth. What is your total dividend for 5 years? You calculate that. That comes to 57,235,313. This is the gross dividend, total gross dividend. If you want to get the net dividend received by Sri Lal, you take the 57 million into actually 92%. 8% you are paying withholding tax. As an investor, he will get net of tax. So 52,656,488. So this is the Sri Lal dividend for the 5 years. Net dividend he will receive. Net dividend he will receive 52.6 million. So please understand, you are paying 37.5 million first year, right? Your dividend for current year, that will grow at 10% for 5-year period. So what is the 5-year dividend, next 5-year dividends? Okay, so this is the total dividend you will receive for the first 5 years. That's one portion of the question. The second part is asking you assess the value of equity of Sri Lal ownership in the company. So as we know that you have to value the shares. Value the shares. What is the method of valuation? What is the method of valuation? Dividend growth method. Why dividend growth model? Because you have been given a dividend cash flow and they are giving you a growth rate also. Dividend also given and dividend growth rate is given. So value under dividend growth model. So formula is DO 1 plus G R minus G. DO 1 plus G R minus G. So we need to find out what is the required rate of return. Required rate of return of the investor. So required rate of return of the investor, we will be using Capm model. According to that, cost of equity or expected return is equal to risk-free rate beta market return minus risk-free rate. So you need to calculate the required rate of return of the investor, which is using Capm model. We can calculate the expected return of the investor or cost of equity. So risk-free rate, they have given the risk-free rate as risk-free rate is 8%, beta 1.2, and your risk premium 13 minus 8%. So your cost of equity or the expected return will be 14%. Cost of equity or the expected return of the investor is 14% using Capm model. Capm model, you can calculate expected return, the risk-free rate plus the risk premium multiplied by your systematic risk 1.2. So your company specific risk premium is multiplication by beta into the risk premium of the market. Risk premium of the market is 5%. 5% into company specific beta 1.2. So company specific risk premium 6%. 6% plus risk free 8%, 14. That means the investor, in order to invest in this company, I would need 8% risk free rate plus a risk premium of 6%. So I want 14%. So if I say my total dividend 37.5 million. Total dividend 37.5 million, and net dividend, this is a gross dividend. Net dividend, actually please understand this dividend has to be always net. If the investor has withholding tax, your investor point only we are valuing the share. Investor point only we are valuing the share. So investor point of view, the dividend what you get is a net dividend. You are interested about net dividend. So net dividend, you see net dividend is going to be 37,500 into 92%. 92% of that, which is 34.5 million. Total dividend, net dividend 34,500. And Sri Lal ownership, Sri Lal will get only 25%. Sri Lal own 25%. So how much Sri Lal will get? 8,625,000. This is a Sri Lal percentage or Sri Lal amount of dividend, net dividend what you will get 8.6 million. Total dividend 37.5, 92% only the shareholder will get because the withholding tax by the company will be paying on behalf of the shareholders. 34.5 million net dividend they will get. Out of that 25% only Sri Lal has. So Sri Lal get 8.6 million. So your dividend 8,625,000 1.10%, growth rate is 10%, or 14% minus 10%. So value of shareholder, value of the shares for Sri Lal. For Sri Lal, value of the shares of the company 237.2 billion, 2 million. 237.2 million. So please note that this is a simple valuation question using dividend growth model, and they have given you the CAPM information to calculate the required rate of return, as well as they have given you the gross and net dividend. Actually speaking, nowadays in Sri Lanka we don't have withholding tax on the dividends, so the dividends will be paid to the shareholder. Shareholder will be liable for the dividend income. So whatever the amount he received, gross dividend, on which he will have to calculate the tax and pay. Not like normal other income he get from other incomes, he will take the dividend income and calculate tax on that. So the shareholder company will not be deducting withholding tax and paying. So as a shareholder I will get the gross dividend only. But in this example they have given you the withholding tax. So net dividend only we are taking into consideration, because our valuation has to be net dividend based. What you receive. So on that basis 8.6 million Sri Lal get for his 25% ownership, and the value of the ownership is 237.2 million. So the based on future dividend cash flows, present value of the future dividend cash flow for the Sri Lal 237.2 million. Now understand this, shareholder Sri Lal didn't put single cent, he got promoter shares, 25% ownership is promoter shares for his goodwill and the expertise and his business knowledge. So he got shares free of charge, and the share is worth based on dividend cash flow method 237.2 million. This is a dividend growth method, they have given you 237.2 million. So this is basically the question number 2.